All right, folks, welcome back to Dirty Boots Capital. I'm your host, Tony Lopes, and today we have with us the awesome Derek Marlin, the CEO of Elevation. So we're going to be talking with him for the next 20, 30 minutes, and he's going to be sharing with you some gold, some very important information here with the real estate market, where he sees things going and how he helps folks within real estate. So this is going to be some very good conversation. Derek, welcome to Dirty Boots Capital.
Tony, thanks for having me. Appreciate it.
Yeah, this is going to be great. So, why don't we start with a little bit of a backstory? Tell the folks a little bit about yourself and how you got to where you are today, being CEO of Elevation.
Yeah, so I'll do kind of the condensed version because it's a long and winding road. I think to your point, we talked off camera of like people have this direct line to real estate, and that was not the case for me. So originally, I'm from back east. I'm from New Jersey, and my whole family are Wall Street folks, but they're on the fixed income side. So everybody was a trader or salesperson with the bond side versus the equity side. So I kind of grew up in a finance family, but I moved when I was younger to Colorado and have spent the majority of our lives in Colorado. Wanted to do it something totally different, kind of went off the beaten path for what the family wanted, and I decided I wanted to get into professional sports. So I went and got my MBA in sports management from the University of Florida in Gainesville, and that helped me get into the NFL. So I worked for the Denver Broncos for 6 years doing corporate sponsorships and marketing. So it's nice to see the Broncos remotely decent again. We had a little rough stretch there for a while. So that's good. And then I kind of got burnt out on that in that I worked so much, and my wife owned a wedding planning business. So we were like two ships passing in the night. Like we just never saw each other. We had little kids and we just thought this is not the best opportunity. So I shifted into media in 2008 and I sold advertising through CBS television. And I got a couple years in, and I, to kind of parlay this into real estate, is one of my coworkers. This was the financial crash, and we're still selling expensive advertising. And she drove a nicer car. She was less stressed. She had super nice clothes on and just was super refined. And I pulled her aside and I was like, "What are you doing?" And she was buying rental properties. And so the Colorado in general and the Denver market got hit pretty hard. That we had a big run up. Didn't get hurt too bad during the tech bubble of 2000 and 2001, kept running up, but the housing crash, we had a significant amount of inventory, lots of foreclosures. And so I started buying turnkey rental properties in 2009. And that was kind of my first foray into real estate.
That's amazing, and I appreciate you sharing that level of detail because a lot of the listeners out there, they can relate. They can relate to 2008, 2009 when the that crash happened, and a lot of them can relate to just being with their spouse, two ships passing in the night. Everybody's busy. They're all trying to live their lives, trying to live their best life, and trying to give the kids the most that they possibly can. And it creates a lot of stress. And so good for you. You've got to the other side of that where you're living in a less stressful world. You understand the importance of real estate. That's what we do here on this channel. We talk a lot about real estate because we truly believe in using it as an asset to create not just wealth for ourselves long term, but also create cash flow so we have an easier, more gentle life that we can enjoy day to day. So thank you for sharing that because yeah, a lot of us in real estate, you and I, we didn't come for money. We didn't come for millions. Nobody gave us what we have. It was a lot of work and some sweat equity on the front end of it. And if you stick with it and you kind of have that marathon mentality that this is going to take some time to create a portfolio of real estate for yourself, you get to the other side with a really good news story. So thank you for sharing that, Derek. I appreciate it. So being in real estate for quite some time now, what do you see 2025 has in store for us for the real estate market, right? Here we are in January. We're kind of looking at things saying, looking at us here in this year.
Yeah, and I'll give a little context that I love that question in that so your audience knows kind of where our expertise is in the market, because I think it's obviously a little different based on where people are focusing. So our day-to-day business now is doing fix and flips in the Colorado market. We also do some wholesaling to our network of fellow investors. I've got a brokerage division as well. So we have people that have their licenses and focused on investment real estate. And then we own some commercial as well. So we have exposure to the office space. We own a co-work space that we work out of. And our last division is a hedge fund division. So we work with institutional capital. And so we kind of have a nice broad overview of the market. I've done some multifamily in time in the Midwest. I've invested in state and out of state. So to kind of zoom back down into where do I think the market's going, I'm going to speak from more of a residential investment real estate side. But in general, I think the term we've been using for a long time is just higher for longer. I think rates are going to continue to be higher for a longer period of time. I think the Fed is very jumpy on cutting rates too fast. And I also, from my background in the municipal finance and fixed income world, I've got buddies who are still traders. And so they kind of give me insight into where the 10 years going, and they're really, really smart people, and they're all betting a little higher for longer as well. So I think we are coming out of record low transactional volume. So I think it's going to be a little bit more of the same. Again, our folks have their license hung at eXp Realty. So we just came back from their huge national conference, and that's the 800-pound gorilla in brokerage in our world. And they've got great insight, and they're projecting about a 10% increase in transactional volume across all residential real estate, whether it's investment or traditional. I kind of agree with that. That's what we see in Colorado. We're seeing anywhere from a 3 to 4% appreciation over the next 12 months. Just reasonable appreciation. And because we're just so still down in supply, to me, I'm a hyper focused guy on supply and demand. Our inventory levels are up in Denver. I mean, we're still up about 30% to pre-COVID. I kind of throw COVID out because it was such a crazy time with no inventory on the market. So I think we're going to be higher for longer. I think we're going to have a modest increase in volume. On the flip side, we see properties that are done really well and they're priced appropriately. They go under contract in our market in 1 to 2 weeks. They fly off the shelf. You might get slightly over asking. It's not the good old days of 20 or 30 offers and 100 grand over asking in our market. But if they are priced ineffectively, and many times you've got a lot of agents that just don't have experience and they're pricing like it was 2021, it's going to sit for 3 or 4 months and you're going to drop the price 30, 40, 50, 60 grand. So it's this weird kind of like split market, in my opinion. If you're doing it right, you're not getting greedy, you're underwriting profit up front, and you just hit singles and doubles, using a sports analogy, people are doing well. If you're swinging for the fences and hitting home runs, you're going to get burned, in my opinion.
I agree with you, and I don't agree with you just to agree with you.
Yeah.
We take a look at the data as well, and we're seeing the same thing. You mentioned
Awesome.
the 10-year. You have friends who are in the bond market, and they see the 10-year continuing to either hold steady or go up.
Yeah.
And the reason why you bring that up is because the 30-year mortgage follows the 10-year. Right. And so if the
Correct.
10-year continues to go up by 5 basis points, 10 basis points, whatever it is, the 30-year mortgage will follow. So that's the correlation there, why Derek's making that correlation to the 10-year treasury. And that's one of the things we watch as well, and we see the same thing. And then another data point we've looked at is we follow super smart guys like yourself and
Yeah.
these analysts who look at the futures market for the raw materials that go into building a home, right?
Mm-hmm.
So we look at the futures market, what the price is going to be in the futures market for rebar, for concrete, for vinyl, for aluminum, for all these different products, right? This basket of goods that goes into building a house.
Mm-hmm.
And so over the next year, all of those items, except for maybe oil, right? All
Yep.
of those items are higher a year from
Mm-hmm.
now. So these super smart analysts are predicting. Right. We
Yep.
can always have a black swan event. That could happen. World War III, something happened in the world. We don't know.
Yeah.
So I don't want to say this is a for sure. But assuming things just kind of trend in the direction as we think they are, with no major life events, world, global, geopolitical events happening, we think those items going into the basket of construction for a home are going to be higher a year from now than they are today. So it's all hanging true. Your story hangs true with what I've looked at as well. So that's
Awesome.
all it is. We don't conflict on any of that. So you mentioned the market that you're in. You're in the fix and flip. You have some commercial. You have some retail. What's your favorite asset class like right now? Like if you had like $1 million to spend, where would you focus that $1 million to go?
Yeah, I'll give you kind of two answers because I think your audience is a lot like our audience on our podcast, and that you've got some folks starting out, you've got folks that maybe can't just quit their day job. They're looking to build active and or passive income. So I'll answer it first from, if you're not trying to make, and this is really what we do as a business philosophy, chunks of money. We love flipping properties. Yes, it is riskier, but you can make larger chunks of money. You can rinse and repeat. It is essentially a job. I mean, I think HGTV and Magnolia Network make it look easy and simple and sexy and beautiful. but there's some rough times. So I look at it really as a job. But then you can take that capital and where do you then place it more on building wealth through real estate and different asset classes. So I still love flipping. We do some wholesaling as well because I hit a certain threshold of company capital where I run out of funds and we can raise more funds and do 50 flips at once instead of 20, let's say, but I'd rather wholesale. So I still love flipping, and we've got a really great system, and the Colorado market is still very healthy. But when it comes to investing for the long term, we were in small multifamily and single family rentals. When I first mentioned that I started buying in 09, we bought through 2013, bought 15 different assets between fourplexes, duplexes, single families. Those were great, love those, kind of wanted to scale up. So we sold all those off and got into multifamily in the Midwest. And to me, I think your folks have to really think of like how much time do they want to invest versus active and passive. So I love multifamily. I think that market is a bit saturated, even in the Midwest. So we sold our stuff off. And I try to follow a little bit of the Warren Buffett philosophy of definitely if everybody's running for the same asset class, you should be a little hesitant. And if everybody's running the opposite direction, you should maybe lean in. And that's how we got into multifamily. People thought I was out of my mind buying rentals in 2008, 9, and 10. That ended up being pretty good. We sold that off and we now own small office buildings. So obviously with coming out of COVID, the big WeWorks of the world going bankrupt and some of the big office class A buildings, I don't touch that, but we have essentially reposition and we are sitting in a co-work space that we own. That's a 7,000 square foot building. It's got cool bones. It's got great culture. It's in an opportunity zone. So we're investing our personal capital and trying to pick up kind of boutique co-work spaces that we can own, run, and manage and start to roll those up. And it's under the institutional capital radar, but it's above what somebody might be able to buy as a single family rental. So we really actually love office buildings, boutique office buildings, and co-work spaces.
Yeah, that's great. That's a great message there. There's a lot of folks you and I have seen running towards multifamily space, and I love multifamilies. But I look at some of the deals people are putting together and some of the pro formers they're looking at, and I'm just like, wow, that just seems like a lot of risk. So if listeners and viewers are looking at multifamily, God bless you. We're not turning you off to that. We just
Yeah.
want to share with you. Be careful and be conservative in your pro formas and how you do your underwriting. Just be careful there.
Yeah.
Yeah, we look at a lot of deals that just don't for multifamily space just don't pencil out. So we've gone bigger in
Mm-hmm.
the apartment complex space
Mm-hmm.
because there's more, you can spread your cost over many more units, right? Versus, hey, I have to replace a roof and it's on a duplex. I can just spread that over 2 units versus spreading it over 50 units, right? So,
Yeah.
so we definitely amortize that over more units, and that's how we kind of get the economies of scale working in our favor. So we love multifamilies, but some of these small multifamilies, it's kind of tough. The
Yeah.
commercial, just to maybe talk a little bit about that. The thing that's
Mm-hmm.
always concerned me personally with
Yeah.
commercial has been with vacancies for commercial. I understand the motivation to buy it now because
Mm-hmm.
there's less demand, and so there's great opportunity to get it at a lower cost, which is where we want to be. In terms of filling that vacant space, if there is a vacancy, tell us a little bit about the length of time you're typically seeing to fill that vacancy and maybe some of the other risk factors people should be aware of with office space.
Yeah, that's a great question. I think that for us, and I'll give a little bit of context of where we're coming from, everybody does it typically based on classes. So obviously your A class office building are your high-end law firms, your engineering firms, your finance firms. They're paying for beautiful high rises, whether it's, in Boston or in Denver or LA or whatever else, and you're just paying a significant amount of money. And that's the big boys. That's the BlackRocks. That's the funds that own those. That B and C class office building are the regional centers. We're kind of from a size standpoint, I'll just give you the metrics on our current building. We've got a 7,000 square foot building. It's in a suburb just slightly south of Metro Denver. And we've got 24 private offices and we've got 6 dedicated desks. And then we have a bunch of other amenities. So we have a podcast studio. We've got spaces to rent for conference rooms. We do different meetups and stuff like that. So we took this old crappy building, took it down to the studs, and essentially rebuilt it and went from 0% occupancy. And then it took us about 15 months to hit 90% occupancy. And right now we're 97% occupied. So to me, it's this niche product. I think you're right. There's some hesitation if I was out there buying 50 and 60,000 square foot office buildings. It's definitely taking us longer to rent them than we thought. I think we were a little overly aggressive because we leaned into our real estate community thinking, well, why can't I get another mortgage broker that I do business with, a hard money lender, a title company? It was a little slower to roll that out. The good thing is the city has been super helpful to work with. They want these buildings revitalized. So from a permitting process, we've gotten a couple grants because we've redone the whole thing. I think that's been really, really helpful. Something we did not see coming was the challenging on the finance side. So what we did is we had a couple really good years working with hedge funds. We wanted to have a ton of equity in this building. So we used, bought it on a note and then did all the rehab internally. And we're going to have about a 50 to 60% equity position. We realized we had too much capital in the building. And so we said, well, let's refi. We're now in a full year of trying to find the right bank and the right partner to refi because everybody is hesitant. So they're taking it from the most conservative perspective possible. We're showing them our real numbers over the last 2 years, but had I done just a straight construction loan up front where the bank is funding the rehab, it would have been no big deal. And we kind of shot ourselves in the foot there. So that's a big lesson learned, is having that financing that's going to take a little longer. It's going to be a little tougher to refi in the back end. So if you've got that longer runway, I think that's where the opportunity is. People are going in trying to do something in 1, 2, 3 years. Yeah, I would be really nervous, but for us, this is a legacy asset. We want to own it forever. We're trying to acquire properties on both sides of us. So that's working for us. But yeah, you got a short time frame. That's a little scary.
Yeah, I love what you had mentioned relative to the market, that specific location, and what's happening with the city being willing to work with you to
Mhm.
get the permits and get things in place so you can do what you need to do. And that's one of the things we stress is for first timers or even folks who are looking to invest for the second or third time, maybe look local. Right?
Mhm.
Don't try to go outside your area. If you happen to find something outside your area with a partner or somebody that's very well versed in a particular location, great. But chances are look local because that's
Yeah.
where you're going to know that market better than anybody else. You're going to know it better than Derek. You're going to know it better than
Yeah.
me, right? You're
Yeah.
going to know if the school's going to be expanding, building on a new high school. You're going to know if there's a hospital coming to that area. You're going to know if there's a new hotel that was just built down the road from you.
Yeah.
What's happening with businesses coming into your particular location. That so much better. And so if you see that, right, for example, a hospital, if you see a hospital coming into your particular town or city or nearby, maybe in that area there's some of these small office buildings that can be expanded, converted, single offices for private care, right? For private care
Mhm.
doctors who also work at the hospital, but also want to have their own private office, right? Maybe there's some opportunities there that you can kind of envision, but you need to understand your local market first and foremost
Right.
to know if that's going to be possible. So I love the message you had sent there relative to that. So commercial, a little more difficult,
Mhm.
little more risk to it. Definitely some good opportunities these days relative to maybe getting something at a good price. So there's some
Mhm.
risk, some pros and cons relative to
Mhm.
that. For first-time investors, where do you see maybe today the best place for them to kind of sink their teeth into and be able to either make some cash flow or gain some equity?
Yeah, absolutely. To me, it's funny. Back in the day, we didn't really have a term for it, but now it's called house hacking. And so, if you're able to move into a primary residence, you're able to buy a property that's beat up. Let's say that you're younger and you're in an urban area. If you can buy like the duplex that you mentioned, live in one side, fix up the other, rent it, and then every 2 or 3 years, if you can just rinse and repeat it and be able to take a little bit of equity out of that home as a down payment on the next property, you can wake up in 10 years and have anywhere from 4 to 8 hopefully cash flowing assets depending upon the purchase price and the market that you're in. There's tremendous tax savings. I think that's really, really important. People don't really factor in the depreciation, the ability to pay down debt to offset your ordinary income. So yeah, if I'm early on, I'm house hacking all the way. And we're using it kind of at the other end of the spectrum. We just sent our first kiddo off to college, and we're starting to run the numbers of, hey, they're in a unique market. How can they meet friends? And I want to teach my kids wealth through real estate, even though none of them are showing they want to be in the business. They want to do very different things. I've got a junior and a sophomore right behind them. So it's like if we can get them into a property and they learn how to manage it with their friends, they've lived in the dorms anyways. We're trying to see, does it make sense to essentially teach them, and then that becomes their asset. So whether you're a beginner or you're trying to kind of build family wealth, yeah, I think single family house hacking and rinse and repeating and living in a place and fixing it up and just kind of playing the long game and always living under your means, it's almost a can't lose strategy. Obviously there's always risks, but to me that's a no brainer. And then you get to that point where you're in your 40s, 50s, and 60s, and you can really accelerate it. And you look back and you've got assets that are free and clear, put them on 15-year notes. I think that's a no-brainer if you're more on the entry level side.
I love that you're doing it with your kids,
Yeah.
because I agree, right? Your kids are probably going to change their mind 10 times over, and not that kids are bad or anything like that, but they're experiencing so many new things so rapidly that their mind just is forming and it's changing so quickly. What they like today, they don't like tomorrow. And so having this exposure, even though today they're saying, Dad, why are we doing this? I don't want to be a landlord. That education will always be with them, right?
Mhm.
And
Yeah.
if they take to it, great. Maybe when they graduate, they land someplace else. They continue to do the same thing. So now maybe they have two cash flowing
Mhm.
assets, which is great for a young 24-year-old person coming out of college, right? To be able to have two cash flowing assets, that's a huge win. That's something I didn't have. That is, I think that education is fantastic. I love the story with a duplex and being able to rent one side, live in the other. I'm going to throw one other out there, and
Mhm.
it's based on just the macro space that we're in today, this
Mhm.
affordability crunch that we have, and towns and cities. Again, knowing our local markets, right? Our local markets are much more open to creating housing. So
Yeah.
one thing we also advocate for is if you can buy the right single family home and add a ADU, accessory
Yeah.
dwelling unit, right?
Mhm.
Most cities and towns are open to you doing that, as long as it's within certain zoning regulations. That's an opportunity that did not exist when I came through the ranks, so to speak.
Mhm.
Towns
Yeah.
and cities were not open to just creating an ADU, but because
Yeah.
we have this nationwide affordability issue, they're much more open to saying, yes, go ahead, you can convert the basement to an apartment, or you can add on to the garage and create an apartment over the garage or in back of the garage, right? And that's a great way to create that cash flow with a second apartment, or I should say, and you're also
Mhm.
creating equity in that home, right? Because now the home has more to offer. It's a better asset to not just homeowners that may be looking in the future when you go to sell it, but also to investors. It's just a better asset at the end of the day. And so you've created a lot of value. So I'm just throwing that out there for folks who maybe haven't heard the message from me before. I think that's a great way for young people coming up to be able to create some equity for themselves. You had mentioned how you and the for office space you had to go
Mhm.
through some funding options,
Mhm.
and I know today dealing with real estate as well as you, funding in the last year was difficult.
Yeah.
Not everybody was lending. There was a lot of hoops you got to jump through, and so in terms of funding, what do you see going into 2025? Do you think that's going to become easier? What are the easier routes for folks to go through for funding their deal?
Yeah, I think that's a really good question. I think if you're going, let's call it the entry level, more traditional route of trying to buy single family rentals or small multifamily, that market is still seems to be pretty healthy. You're obviously having to put down a larger down payment. Right now, you're paying in the higher sevens for rates versus even maybe 6 months ago we were in the sixes. So traditional financing of putting down 20 or 25%, having a good W-2 job, being able to qualify there, that's your kind of path of least resistance, your best financing options. If you're leaning towards the flip side of things, it's been interesting that people, you would, I think, intuitively think, well, interest rates are going up. So if you're borrowing money kind of in a private fashion or hard money fashion, you would be paying a lot more. And we've seen this interesting thing over the last 2 or 3 years in our market. And I have a lot of buddies who are doing our same model just in different markets. Is there's so much generational wealth out there. There's this
Mm.
huge transfer going, and even that private equity and institutions are getting into hard money lending. And the difference between that is that's essentially where someone is helping fund your flip instead of having $500,000 to buy it and 100 grand to remodel on your own and having all your 600 all in. You're able to go to a lender and they'll loan you between 10 and 20, or I should say, you will need to bring in 10 to 20% in your equity position, and they'll charge you anywhere from 1 to 4% of the purchase price of the property, and then you're going to charge you 10 to 14% interest. Again, very different per market. You would think that would go way up. We've seen that those numbers come down because there's so much competition. So we're seeing even first-time investors, and we help people, they partner with us from an education standpoint, so they get better rates. But we just had one of our clients help get a hard money loan on a more expensive property in Metro Denver, where they were able to secure it for 1 point or 1% upfront for the purchase price and 10% interest. And so for hard money, that's really, really good. That's almost closer to private money. And then friends and family money, the wealthy uncle or aunt you might have, I think that even though there's not this huge spread, you can borrow from them at 7, 8, 9%, maybe a point. So funding is much more available if you've got experience, if you don't partner up with somebody who does have experience. And we're seeing the debt markets be decent, where we got again kind of stuck as the quote unquote traditional commercial real estate markets in office space, a little bit in multifamily, that people just pulled back the reins because we had a couple banks go under and everybody got a little bit skittish.
Yeah, yeah, I love your advocacy for private money. Sometimes folks shy away from it. The hard money piece just scares them. But I too speak, I won't say a lot about it, but I definitely offer it out there because even though, and I think this is an important piece, and it's obviously part of what you guys do there at Elevation, when you partner with a hard money lender or private equity, they're going to have skin in the game if they fund your deal, and they want to make sure that it's going to be successful. So if
Yes.
this is your first flip, your first multifamily, your first office building, right? They're going to be that second set of eyes running through the numbers, making sure that you're conservative, right? Early on, I had spoken about looking at pro formas where folks are just like pie in the sky. And I'm like, wow, this, you need to be more conservative about things, right? They're going to be the people who are going to be more conservative
Yeah.
and maybe increase your vacancy rates, whatever it is, because they want to make sure their money is safe if they're going to be placing it with you. So, and plus, if they're coming with real estate experience, right, they're going to be able to train you if you're a first time investor, even a second or third time investor. They're going to be able to come along as a private money person and train you how to do the underwriting if you're not familiar with how to do it, right? Or give you some better tools, some better resources, meaning, hey, go call this person for insurance quotes, or this attorney if you need a real estate attorney, or how do I buy the property? Should I buy it in my name? Should I buy it in LLC? Should I buy it in a trust? All these sort of things that come up. Having a second person as a private equity partner on a deal is not a bad thing, even though you may be paying a little more for that rate. I think that's insignificant. The more important thing is you get a partner who knows what they're doing. So I love that you
Yeah.
got.
Yeah, well said. It's funny you mentioned that because the way we were flipping our properties when I first started is we had a line of credit at a major brokerage, and they lent us roughly 75% of the value of our portfolio. And so we got a much lower rate. So I got a little sad. I was revisiting a deal from 3 years ago, and our line of credit interest rate was only 4%, which was just amazing. Obviously, it was coming out of the pandemic. Rates were so low, but we were only able to do 3 or 4 flips at once, and then we would burn up our company capital. And I thought, okay, why would I pay higher interest? But we really shifted, and I brought on a CFO, and we focus on cash return, meaning I can, yes, now borrow hard money, and we're at a good volume. So we're borrowing at, roughly 1 point and 9% now, which is phenomenal. But I only have to bring between $100,000 and $200,000 per deal, and I can do exponentially more business. So yes, I'm paying higher interest, but if I can do more business, and as long as they're good, smart deals, I mean, we're essentially doubling our overall revenue, but we're still paying significantly higher rates. So right now, if I use our line of credit, we're paying 6.5%. I'm paying 9.1%, but I can do essentially 3 deals to one. And so, yeah, it's just thinking about it the right way and getting over that fear of other people's money as long as you're diligent. And to your point, Tony, you're spot on. They're not going to fund crappy deals, or else they're the ones that lose 80 to 90% of their money. So they kind of save you from yourselves 9 times out of 10.
Yeah, excellent. I love it. I love it. So tell us a little bit more about what you guys do at Elevation, how you help real estate investors and first timers, all of that. Tell us a little bit about that.
Yeah, absolutely. So again, we're kind of a fix and flip business at heart. I actually, ironically, don't love that term. That's kind of not the best connotation. There's some bad flippers out there. So we actually like to call it property redevelopment. And that's because we don't do scrapes. We don't do new builds. We just take old homes, beat up homes, hoarder homes, folks in the senior citizen space where the house hasn't had love for 30, 40 years. We fix them up and we flip them. We have a partnership program where we actually partner with homeowners. So if the house is beat up, they receive essentially all the equity credit that they've derived over the last 30 years, for example. And let's say it's paid off. And even if it's beat up in our market, it could still easily be worth $500,000. We then fund the rehab ourselves. We run the project and we run it in a super efficient manner. We take emotions out of it. We're all about maximizing revenue with a beautiful design eye. And then we split the extra profits 50-50. So we call that our partnership flip. So we do that, and it kind of helps, again, save people from themselves, give sellers a new option rather than just a cash offer. We do wholesale to other investors. So we really curate a small group of folks that are doing similar things. We want good deals for them. We actually do a sewer scope and a roof inspection with every property we wholesale. Like, I want my people knowing what's going on. It's not fly by night. When we do it all over Metro Denver. And then on the brokerage side, I shied away. Again, I'm not a guy who has a license, but in working with institutions, and what we did is we did a lot of sourcing for hedge funds, and we found them a ton of single family rental properties. So our first client in 21 and 22, when rates were obviously low, in our Denver market, we sourced them just under 300 single family properties. But the way we could get compensated is by having a license and being licensed realtors. So we have a team at eXp Realty where they let us do everything kind of the way we want as investors, but we've got the horsepower of a 87,000 broker operation behind us. So we kind of have the best of both worlds. And that's something that we can help teach investors to actually either get their license or team up with a partner. Maybe one's unlicensed, one is, and expand the business that way. So that's kind of our core. And then we love to educate. So we have a thing called the Elevation Academy, where we teach people a deep dive once a quarter, how to flip properties. Right now it is in person. I'm trying to work with a consultant to make it a virtual product here soon. But right now it is in Colorado. But we've had folks come in from other markets, take it, change it a little for their design style. Obviously, what looks good in Florida is different than Denver. And then we do stuff through our podcast as well from an education standpoint. So just trying to get out there and help and educate. And we're junkies at doing the business. Like, I always had a hard time when I went to college. I had this great marketing professor, God bless Norm, but like, he was teaching us personal selling. And the last time he sold was 1960, and he sold suits. And this dates me, I'm old. I went to college in the 90s. I can't do that. So our business is still 90% doing the thing. And we do 10% coaching, education, partnerships, training, because I can't get away from doing the thing. I just like it.
I love it, Derek. I really do. I really love what you guys are doing, because at the end of the day, I haven't seen any other community other than the real estate community where folks like you and I are working really hard to help others achieve their dream, right? Just grow their wealth, get more cash flow, live a better life. I mean, that's the passion that folks like you and I have, and I love all that you're doing. I took a look at your website, just bang up job there on, again, just all that you guys are doing. So for the folks that want to reach out to you, learn a little more, how do they get in contact with you? And why don't you share your website as well?
Yeah, absolutely. So our core website is just elevationinvest.com, just all spelled out, elevationinvest.com. They can get with me. They can email me directly. So it's just Derek, Derek, at elevationinvest.com. And then on Instagram, they can connect with us there, and it's just at Elevation Invest, and they can DM me there, or LinkedIn. Shoot me a message on LinkedIn. Just find Derek Marlin, and we do newsletters. We do a ton of content there, so they can find me on LinkedIn just under Derek Marlin and Elevation.
I love it. So folks out there, please connect with Derek for the education piece alone. I mean, man, massive value there. So connect with him on those social media sites, and check out his website. Derek, thank you so much for your time today with us here at Dirty Boots Capital. Really appreciate you. And yeah, all the best for you and all those other investors in 2025.
Thank you, Tony. I really appreciate it. It's been so fun to be on your podcast, and love what you're doing for your community too. Thank you, man.
Awesome. Thank you.